Hello, everybody, and welcome to another Crypto Deferred Sales Trust Mastermind, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy, such as the Deferred Sales Trust, is the best way for you to exit highly appreciated cryptocurrency, defer millions of dollars of capital gains tax, invest into real estate, securities, businesses, all tax deferred, so you can create and preserve more wealth. For those who don't know me, my name is Brett Swarts, and I'm with my business partners Jake Miller and Pierce York as well, where every week we're hosting this meetup and this gathering of hopefully really smart people in the cryptocurrency world, financial advising, real estate, and tax deferral world. We're trying to bring these worlds together and make it very seamless for our clients and our business professionals who help high net worth clients to create and preserve more wealth with their highly appreciated assets. And so I'm excited to be back again and to share the vision of what we're doing here, as well as we talk about the deal close story of the week. And then we just open it up for questions. So any questions that you want to ask, you can ask. And we want to explore how we can help you out in the best possible way. Jake Muller, anything to add to that intro?
Again, in the sense that we're all kind of like-minded, we want to circle the conversation around those assets that are highly appreciated, those that might be subject to capital gains, those that have an eligible transaction, where the pain point is significant enough that you want to do something besides just pay the taxes now. And we're not saying that you won't someday pay it, but maybe make the best and full use of those dollars today so that you can snowball your investments going forward and maximize the efficiency of your wealth.
Absolutely. And Pierce, he's on the way from Newport Beach up to Sacramento. We're probably going to get the families together this weekend, Pierce. So Pierce, how are you doing? And how did Man on the Street last week go? Did you have a chance to get out there and talk with the luxury owners of real estate and their highly appreciated homes that they might want to sell?
Yeah. So, coming up north right now. And Man on the Street went well on Friday. Last Friday, it was actually on a commercial property. So I will be posting that video when we're ready to release the actual listing. So Excellent. We're kind of trying to keep it on the down low until we go full market. So
big announcement. Love it. And so what we all share in common, Pierce, Jake, and I, is a love for real estate, a love for investing, a love for entrepreneurs, folks who are looking to create and preserve more wealth or help their clients do the same. And so let's dive right into the deal close story of the week. This one's actually closing next week. All contingencies have been removed and they're good to go. But this is a gentleman out of Arizona, and he's selling an apartment complex. And that apartment complex is basically fully depreciated. And the asset is selling for above $2 million. I think he just has a couple $100,000 of debt. Pretty close to it, and he's looking at a huge capital gains tax. Arizona is a little more favorable than like a California, right? You have state, you have federal, you have Obamacare, you have depreciation recapture. But we like to say it's somewhere usually between 30 and 50% of your gain with the depreciation recapture when it comes to like real estate assets. Now, if it's crypto, it's different. There's nothing to depreciate, right? So it would just be state and federal. So that's something to be aware of. But again, 30% is a pretty good number. So if you have a gain of $1 million, boom, expect about $300,000 being taxed. And so, in fact, we did Jake and I just did a Bitcoin deal for a client. She bought Bitcoin for 50,000 and went to 50 million. She exited 5 million. She lived in California. So I think the tax liability, if you took about on that scenario, she's looking at about 37% state and federal, right? That's about $1.85 million. So all of these things are important. So this gentleman, he's selling in Arizona. He has a little bit of a break because it's Arizona, but overall, he was looking at a substantial capital gains tax. In fact, Jake, I don't know if you look up Arizona. I think Arizona is around 5% or 4 point something there. But you have 20% federal. Then you have the Obamacare of 3.8%. And then you have another 4%. So I like to use about 30. I think it's going to be a fair number with the depreciation recapture. So his difference is $510,000. So he could either sell the asset, and for his scenario, he could have done a 1031 exchange, but he's in his 70s. He's been owning and running this property for 20 years, and this is his retirement. He doesn't believe the marketplace makes a lot of sense for 1031 money right now for what he's seeing, especially in the Arizona market. It's like red hot. Values are really high. And he's just going, but he goes, number two, Brett, even if I found a deal, like I don't necessarily want to own and manage it and run this, or have to deal with any potential, COVID restriction laws or eviction moratoriums or any of that. I'm kind of done with all that. So how do I just diversify? How do I get liquidity? How do I keep my funds safe? For him, that meant stock market. So some of our clients, they want to go back into real estate. They're more entrepreneurial. Some want to go back into crypto. Some want to just go 100% to securities. And that's what it means for him. And so he's selling, he's closing. And in fact, I'll be signing the notary here on Thursday officially to close on Friday of next week. But he's been exploring this for about a year. So he first saw me on a podcast, or heard me on a podcast, watched some YouTube channel stuff, like maybe what you're doing right now. And then he started to explore the concept, meet with the tax team, go through all of the analysis, go through his risk tolerance. And so all the way coming through here, we've officially closed. And so that's an extra $510,000, right, that he's been able to defer. Remember, he's become the lender to the trust. So instead of having about 1.2 million after tax, it's 1.7 million in the trust. And now it's invested again in stocks, bonds, mutual funds. Now that doesn't mean he won't go back into other real estate opportunities, and he can go passively into those other deals if he wants to. But at this time, he's just wanting to be calm and in like the biggest companies in the world. Jake, anything to pull out of that so far? Any questions, any nuggets there?
Well, kind of along the lines of life after the Deferred Sales Trust. You mentioned that some people, for them, safe and security is money and marketable securities, what have you. For other people, it might be something completely different. The power here is that you're able to diversify and be in control not only of your assets, but also the timing of when you take distributions personally and incur that tax. So those are three critical things. And just as another example of a mutual client of ours, Brett, that is, I guess, a potential client, he's waiting for the right time to get out of crypto, right? So this one hasn't pulled the trigger yet. But his future goals are, one, a foundation, and two, conservatively invest in real estate because he's had some bad experiences. And then three, getting back into crypto. And then four, having some marketable securities. So he's looking at a very overall diversification of things that he's had previously, when crypto is what brought him to this opportunity where he has a very large taxable yet.
Yeah, absolutely. And that the flexibility of the deferred sales trust and not having to put all your eggs into one deal, one property, one opportunity, ground up development. In fact, I want to welcome John Mudgett to the call as well. I was just talking with Shay, John, and
Hey, dude.
yeah, how are you, sir? You're looking
Doing
more
great, man.
distinguished than ever, by the way. You've gone fully gray here. Before, when you're in Sacramento, I think maybe going to Tennessee, you just start to relax a little bit more versus California. But tell us a little bit about you, John, and then I want to dive in a little bit about Shay's deal and kind of talk on that. I think this would be a cool thing that you joined us today.
Yeah, so I saw Shay reposted on LinkedIn, and I listened to probably 25 minutes of that conversation before I had to go. And then that was yesterday. And so here we are. And it came up in my calendar, and I was like, hey, it was fresh in my mind. We have a snow day in Tennessee, so the roads are all kind of iced up. I'm working from home. And so I figured it was a perfect opportunity to join you guys for the call.
Awesome. And talk about a little about your expertise and your specialty and how we got connected.
Yeah. So I'm in commercial real estate and investment. I've been doing it for about 16 years, lived in Sacramento for the last 11 years before moving to Nashville, Tennessee at the tail end of 2020. So we've been here for about a year. I'm a broker, I'm an investor, and just a friend of Brett's going back. I don't even know, dude.
Right when we got married, right? Which is like 13, 14 years. Yeah.
Yeah. A while ago. So
Yeah, absolutely. And then they also connect you to, I want to connect Andrew with John and John with Andrew as well here, because Andrew's buying deals, multifamily, which is part of what we're doing here, is trying to network as well. So we'll have Andrew chime in here in a minute. But I brought that up because I just got on a podcast with Shay, and Shay just shared a story. So for those who don't know, Shay was a client of mine, and this shows how the flexibility of this deferred sales trust. His goal was to be into real estate, and more so than that, actively in real estate, and even more than that, he wanted to build ground up development. And John had a chance to tour the property, underwrite the property, closely list the property. They kind of went a different route because they were selling off his individual condos. John's most selling, big apartment complexes and commercial property. But all that being said, he partnered with the trust to build these units. Remember, 1031, you have to do equal greater value, which typically means you're not ever buying land that's of more value than what you're selling. Very rare, right? And then therefore you're having to get construction loans or get private money or get more investors to come in. Not so with the Deferred Sales Trust. He deferred the tax. He sold about a $2.6 million business, deferred hundreds of thousands of dollars of tax, and then partnered with the trust to build it. And you can look up that podcast now by going to Capital Gains Tax Solutions podcast on iTunes and on YouTube channel. Actually, it hasn't dropped on iTunes yet. It'll be on YouTube. Anyway, so he's in the process of exiting that now. So he likes it so much that his business partner, his name is Adam, and Adam was the general contractor. He's now rolling all of those equities into the trust. And this cool thing is they're going to snowball this and go do another project and go do another project. So every time they're exiting, they're deferring. Tennessee's a little more favorable than California, but it's still a good 30, maybe 35% overall potentially depreciation recapture of gains, right? That's going in, and that creates opportunities for them to buy more deals, do more deals, make sense of more deals, right? Because it's no longer just about cash flow, it's about tax flow, right? And so, Jake, talk about a little bit on the back to your client about crypto, right? Who's selling at about 10 million is the target price. And what that means for him. I think it'd be cool for people to hear a little bit of his story, since you've known him for so long, just how big this is for him, what the difference was to the DST versus not using the DST.
Absolutely. So this client is a very humble individual, the kind that wears work clothes with plumber's glue everywhere, because that's what he does. Family of 5 in a small little house in a small little town. And just on his own, instead of having a retirement account or something else, he started putting some of the extra stuff into Bitcoin, Ethereum, and then randomly, not so randomly, I should not say it that way, but like he would study this at night, almost like an analyst, and then he would invest in a lot of different coins. And over time, his expectation was, and he didn't even have the tax rates correct or anything like that. He's like, I'm going to have to give away half of this, because it's grown from almost nothing that I put into something so enormous. I should have to put this away. And that was his expectation, is just, I need to give half of it away to government and taxes and things of that nature. And then with 5 million, I'll be set for life, or I'll be able to live comfortably and not be a plumber anymore, not have to beat my body up, not have to suffer like I currently do in these freezing cold weathers, like you're having a snow day in Tennessee, right, John?
Yeah.
So like this was his outlook prior to discussing it with us. And now, of course, anybody would have let him know that capital gains would only be 20%, not 50, everything else, it wouldn't be taxes, ordinary income, all of that. But the fact that we were able to let him know that in reality, just because normally this would be subject to a capital gains tax rate, and yes, you would have to be given big chunks of this away, that's not a necessity. That is not a moral or ethical responsibility that you have to do it now. In fact, you could continue to utilize that larger amount of funds to make other things happen before you do eventually pay the taxes someday. And that's okay. There is nothing immoral or unethical. There is nothing that is statutorily wrong with that. You just have to do it the right way. And that there's a few ways to go about doing it. And one of the most efficient ways is the Deferred Sales Trust. And then as we went through, Brett, and just explained to him the ins and the outs and how it would work, he's excited. He's ready to pull the trigger as soon as his coins are to the point where it makes sense to pull the trigger. And he's happy to utilize the Deferred Sales Trust as a financial tool, which now allows him to accomplish several more goals that he thought he would have to do without, because he was originally planning on just paying the tax.
Yep, and that's exactly where we've closed. So he's waiting to close. So he's ready to, his target is 10 million, and then he's done, right? He's with kids, he's with family. He's doing some more charitable work. He's doing the things that he wants to spend his highest and best use of his time with, not necessarily just trading time for dollars. Another client who closed, that was the one I told you in the beginning, Jake and I's client, $50,000 of Bitcoin went to 50 million. She exited 5 million. And she's going to do another 1.3 million. Although Bitcoin took a big hit after the new year, it's been down a bit, right? And so we're waiting for a certain target price, but she's already exited, and she used that to fund her business dream. She no longer works for the big tech company, and she's doing a startup company. And that's the beauty of this. You can actively be involved by partnering with the trust. We call it the Go Fund Yourself, which is the game changer here. No timing restrictions, no like-kind restrictions, okay? No equal or greater value, no 45-180. Right, multiple assets. He also has them invested in securities, right, for some diversification. And then the next one that closed was a client who did
Brett,
Ethereum.
Before you jump on the next one, I just wanted to touch on this one just a little bit more, because oftentimes, I mean, Richard, John, Andrew, I mean, like, if we're talking about your goals in life, most people talk about your goals, what you want to do with the money. This individual's goals were actually to help an old high school friend, right, Brett?
Yeah.
And so, I mean, whether it's philanthropy, whether it's social impact, whether it's some of these other things, we are having more and more clients that are doing things for others because they can, because now right in this moment, they don't have to pay the tax like they thought they had to. The things that they never were able to get to, they're now getting to financially, as far as investment type projects and making a difference in their communities and making a difference in other people's lives. So the Deferred Sales Trust, and I don't want to get too preachy about this, but it truly opens the doors to opportunities you were otherwise foregoing because you didn't think you had enough reach. Now you do. Sorry, exactly, Brett. Go ahead on the next story.
I like that. It's like taking your charity back instead of charitably donating to the government, which may or may not invest your capital wisely. And you're saying, yeah, actually, no, we can defer that, and you have a little more say over where that goes, which is awesome. I had a question about the Go Fund Yourself. So you liquidate assets, put it into the trust, and Shay said something about being able, or maybe you said something about being able to lend and invest into new projects. Like, what can you walk me through what that looks like if you have a client that liquidates, let's just say $10 million into this, and it goes into the DST, but they want to keep buying. But is it a loan that secures the next property?
It's a great question. I'll take that one first and let Jake chime in a minute. And also I want to test Pierce on this as well. Pierce will be ready. And actually, I also like to get Andrew too to come in because he's been on a few of these as well. So we'll get everyone to kind of chime in on this, because this is literally the reason. If it wasn't for what I'm about to say, I wouldn't even be here. I wouldn't be a deferred sales trustee. I wouldn't be so passionate about what we're about to talk about does, because to me, to sell something and be completely passive is just not the people that I run with. I run with entrepreneurs, people that are investing, who want to be active, who want to do deals, and they're wanting to be in control of their destiny is really what it comes down to, but have the freedom to have optimal timing. So. Yeah, so if it was a loan, John, to answer your question directly, it'd be taxable. So the trust can't fund you via a loan. However, it can joint venture partner with you. And that's the difference. So like back to Shay's deal. So Shay at first became a lender, and I call it lendership, right? So at first he was a lender. He sold, instead of taking $2.6 million from his business sale and incurring all the hundreds of thousands of dollars of tax, he instead sold the asset, the business, to the trust on a 100% installment sale. So he became a lender, right? And the trust sold the ultimate asset to the business partners who bought the business out. So there was 3 parties involved, and it was like 2 transactions: first selling it to the trust, then trust selling it over to the ultimate buyers. So he's left with a $2.6 million promissory note, which is what he owns. That's what he owns now. He doesn't own the trust, because if he owned the trust, he'd be taxable, right? So he can't sell it to himself and still maintain the tax deferral. That's why there's a third party unrelated trustee, and we set up this individual business trust that only does business with him. Okay, which he's the sole creditor. He is the lender, right? He has all the rights and protections there. Nothing moves without his signature or approval. He must approve of investments and movement of funds. Now, I also must approve too. This is understandable, right? This is the part where people have to get comfortable with a third-party unrelated trustee, which is not unlike an IRA company or a 1031 company or things that a 401k company. Like, you don't own the IRA company, you don't own the 401k company, you don't own the 1031 company. There's other intermediaries in between to keep you from what's called constructive receipt. So that's like step foundational 1. Understand that he's the lender. If it just stopped there, the deferred sales trust, it would be maybe a 3 or 4 out of 10, right? And if it was just only stocks, bonds, and mutual funds, completely passive, again, it's still pretty cool. If I'm 70 or 80, ready to be really sleepy and retired, then I that makes sense. But where it becomes, to me, a 9 or 10 or 11 or 12 out of 10, I mean, it just blows it out of everything else out of the water in comparison, is the ability to partner with the trust. So here's step 1. Funds are in the trust. Step 2, Shay goes, hey, I got a business opportunity. It's this land in Clarksville, Tennessee, and I have a partner, and we want to build these 72 units. We don't want to go get necessarily all this funding from the bank. We don't necessarily want to get a bunch of other partners. Can I partner with the trust? And the answer is absolutely. And so he formed a LLC, a smaller LLC versus the bigger LLC, and he did a joint venture partner with the trust. So the trust was funded, or the trust funded that LLC, of which, guess what? Shay, he is the owner of that LLC. So I said it's lendership, right? Like ownership, right? He's a lender first, but now he's an owner, okay? And we structure it in a way where it gives maximum upside for Shay, but as little money in for Shay personally. And the trust puts up the money that owes Shay the money anyways. And so when you see this all boxed out, it's like, it feels a little bit like the Matrix. Like once it clicks, you're like, oh, I get it. Like, wow, how beautiful and elegant and actually very simple. And knowing that he's at first just an installment sale that owes him the money, but the money collateral-wise can be invested in a number of things, one of which can be his own real estate project, of which he's the owner, active manager running the deal. And that's once you get that, like everything changes. You're like, why would I ever use a 1031 ever again? Right? Unless you have a nice deal that makes a lot of sense, that you like the cash flow, you like the deal on its intrinsic value, right? Why would I ever exit out of crypto? Remember, crypto doesn't even work for 1031s. You can't 1031 crypto without using this, or public stock or private stock or businesses or primary homes. None of those work for a 1031 unless you want to give it all the way to charity, which you can do, or throw it into an opportunity zone, which are very hard to find. This is where the elegance of the deferred sales trust comes into play. So John, any questions there? Is that making sense so far?
Yeah, I mean, it is. It's still, I still need to wrap my head around and I don't know if I don't want to consume all the time here, but just the trustee and then the LLC. I'm just thinking, like, I just met with my accountant yesterday or the day before. I'm just thinking, okay, what kind of taxing and accounting and estate complexities does this add to it? And that's just a question that I have that, maybe we'll get answered.
It's a great question. Let's just keep going into this. Jake, do you want to touch about the seamless transition with the promissory note inside of a living trust and how easy that is?
Absolutely. And John, just to let you know, I mean, this is one scenario for Brett's client, Shay, that we're explaining how it worked for Shay. How it might work for you and how it might work for someone else might be a little bit different. And that's the importance and the criticalness of bringing in the brain surgeon, the tax attorneys that work on setting up the DST. And then after that's all said and done, Brett and myself helping you going forward. In fact, just a little background on who I am. Brett says that I'm too modest and I need to toot my own horn a little bit more. And so you mentioned that you went and had a discussion with your CPA. I actually help CPAs across the country know how to structure things like this with the deferred sales trust, as well as other types of strategies. And so I'm a consultant, and in regards to my participation in the Deferred Sales Trust, I wear the hat of a financial advisor for like regulatory purposes. However, Brett and myself help you guys on an ongoing basis make sure that CPA, estate planning attorney, any other advisors and counsel, family members, that everybody is on the same page and that things are being coordinated for an optimal or maximum output, or that your goals and objectives are being accomplished. All right. So we play really well with others. We don't step on people's toes. We just talk at their level and help them understand what's being accomplished so that there's no gray area. Anyway, to answer Brett's question, so if you have a very large asset, I don't know what it is that you might have, John, but let's say that it's a warehouse, or let's say that it's 20 million in crypto, right? You're going to sell it or sell out of your position. And prior to doing that, we exchange the asset for a promissory note. We exchange it with a newly created trust. The trust then receives deed or ownership or shares in whatever it is, right, that we're going to be then transferring to the buyer. The promissory note can be received by you personally. That is not the normal thing that we do. Typically, people are doing estate planning at the same time, and we need to coordinate with what's going on within their estate. Usually there's a living will or a family trust of some kind that is involved. That then becomes the owner of the promissory note, which is the original value of whatever was going to be transferred and exchanged. Now, the nice thing here is we have just made things stop in time. We just took, a proverbial snapshot of the value of things today. So if we have a crypto portfolio of $20 million, we have a promissory note of $20 million. Now, if that moves over into the trust, and the trust through joint ventures or through investing in, a Kraken account into other crypto, or working with Brett to do DeFi exchanges, what have you, or off exchange investments. I mean, all of the fancy stuff that we could possibly do, that might change the $20 million portfolio, which we have a $20 million promissory note that is still inside of your estate, right? But we paused it. This is the magical thing from estate planning. We paused it at that amount. And inside of the Deferred Sales Trust, which is outside of your estate, it can now grow to something dramatically more. Does that make sense? So there's a magical piece here that a lot of estate planning attorneys suddenly have a big light bulb that just almost blows out, because this is a very wonderful thing that oftentimes was not part of their plan.
Which saves 40%, right, of estate tax. So that's another part of this equation. Did a deal in Colorado for a client who's worth $25 million. All of $25 million is inside the taxable state. John, they've been in multifamily forever, and they've only done 1031 exchanges. One of the primary reasons they use the Deferred Sales Trust, besides not finding a 1031, not wanting to necessarily be as active anymore, but was to move the $5 million outside the taxable state in one day without giving it away to charity, which saves 40% of that $5 million, which is a $2 million elimination of estate tax. And that's a powerful ROI as you're looking at bigger pictures, because to us, the tiger by the tail is the cap gains tax. And yes, you get a stepped up basis if you maintain 1031s, but the bigger elephant in the room is that estate tax is 40%. 12 million if you're married is exempt, 22 married, or 12 million single, 22 million married, although it's set to expire in 2025. So these are all the things that we work alongside each individual client to help customize and figure out the best way. And I liken it to a Rubik's Cube, right? And all the colors are all different sides, have different colors. And, John, you have it, and I've got a little bit lined up. Let me throw it to Brett. And then I line it up a little bit, and I throw it to Jake. And then Jake, we throw it to the tax attorneys. And then everybody, and hopefully at the very end of all of us working together, this cube has as much congruence in correct colors, right, on all sides. I wanted to open it up to Andrew too, because I want to bring Andrew in here. Andrew, any thoughts on that? Because you're in the space with us in multifamily, like John and I and Jake. So any thoughts? You might have to unmute yourself, and then also let's talk about what you're doing in that Atlanta deal. I want you and John to get connected on that too.
Yeah, absolutely. I mean, it makes tons of space. I really enjoy the conversation regarding the 1031 exchange and how it sort of complements or maybe competes with, or how it works alongside the DST, right? Because in my space, multifamily real estate, we're syndicating apartment buildings, and it's basically all about the 1031. But I see people who are, they're under the gun on their 45-day identification window, and they start panicking. And of course, the option here that I'm learning that I've thrown out one of my potential 1031 investors who can't get their arms wrapped around or can't, get under contract a deal within 45-day window, is I'm like, hey, you know what? There is this alternative solution, the DST. And you three guys are trying to educate the world, but this is not a well-known strategy. And so I've been sharing this with some of the people that have 1031 money that are potentially putting them into our deals and saying, hey, here's a way that you can continue to pursue this tax deferral and still be very selective and make sure that you hit your criteria on asset class and return. So it's really cool to learn about this thing. It does take a lot of effort to educate your community. That's what you guys are doing here, but it dovetails very nicely with what we're doing at Nighthawk Equity with regard to trying to help our investors and our clients with this tax saving strategy.
And that deal has 215 units, I believe, north of Atlanta. Check out this deal for anyone who's listening. $600 in it takes about 15 to 17,000 to improve the units. Okay, to be fair, but as the units turn and they throw the money into it, and this is and Andrew and Michael Blanc. If you've heard of Michael before, he's amazing, and they team up and they buy these deals. But $600 per unit on over 200 units. Only 15 units have kind of been turned, and that's like almost unheard of. So, Andrew, you want to touch on any of that on those returns?
Yeah, absolutely. I mean, it is a really cool deal we have under contract. It's 214 units in Marietta, Georgia. So for those people that know, it's in the nicer area of town, and it's just sort of the unloved asset in the community. And so it basically requires sort of the C to B upgrade. That's what we specialize in. This is our fifth asset in this area. And so, nothing is a sure thing. If anyone tells you it's a sure thing, you should run the other way. But we have a high degree of confidence in this deal. Me and the partners are combined putting in $1 million of our own money into it. $600 rent bumps. And when you run that across 12 months and across 200 units, and you divide that by a cap rate of about 4.5, there's a lot of value creation that we can do. So we call that forced appreciation, because you're not just kind of counting on the market to hopefully go up. But when you control the net operating income, you sort of control the outcome. At least you have a high degree of influence on the outcome. And so that's why we're pretty fired up about this apartment building.
Absolutely love it. John, do you have a question or thought there?
No, I was trying to do the math in my head because I don't want to unscreen I don't want to lose the link, but I was like, all right, so $600 month is basically mark to market on what's the average rent right now and what's fair market value?
1,100 to 1,700 is the average rent increase. It requires the unit renovation, so about $15,000 to $20,000 per unit of dollars invested in the unit. We're also investing some more money in the exteriors, although the exteriors are mostly complete on the property. So that's those are the numbers. Is 1,100 to 1,700, and then you run that across 12 months, run that across 200 units and the cap rate. And of course, not every dollar of rent increases down to NOI, right? Some expenses do go up. Your insurance will go up. Your property taxes will go up. But most dollars of increased revenue do drop down to NOI. So as a rule of thumb, I usually say 70%. I think it's a little bit conservative or careful.
Seems fair.
But it's very powerful, right? Yeah. So
cool.
I want to open up to Richard real fast and Noel as well. I know we've been kind of talking a lot. I want to see if they have any questions or thoughts and anything else. And then I want to also touch on a deal that's closing here on February 15th. I want to intro that deal and tell you about this story so that you guys are aware. This is kind of a unique one. But Noel or Paul or Richard. Richard, go ahead. It looks like you're unmuted here.
Hi, everyone. This is all exciting. It's good. It's a way to at least address the people that are under USA law jurisdiction and taxation. I'm the founder of Neptunize.io. I'm a marketplace for NFT arts, and some of these NFT arts are going to the roof. Some sell in north of 69 million, 11 million, 7 million. So basically my onboarded collectors and artists are going to be your future customers. So that's how I see it. And so there's about 10,000 artists that are onboarding Neptunize platform with our version 2.0 release. And we have a bunch of affiliates as well that come on board. And these affiliates are actually collectors of the NFTs that the artists drop on NFTnize.io platform. And for example, I have one artist that his collection alone is the largest in the world, and it's going to produce $16.4 billion worth of art inventory that different collectors going to select. He's our featured artist at the website itself. The point is that there's going to be a gamut of U.S. citizen that need this type of protection. So this is my first meet with you guys. I'm actually internalizing, and I got to do a deep dive into what it is that kind of a solution. As you said, there are some people that are older and they just want out of the game, and they don't want to deal with 1031 exchanges at these levels. They just want to make sure that they're shielded as much as they can, enjoy the rest of their life. They don't necessarily want to go back to business. But at least with Neptunize, I've seen 12-year-olds that are playing with large numbers. You know, they're making anywhere between $50,000 to $120,000 a month in profit. And of course, they're 12-year-olds with their parents' credit card, buying and flipping NFTs. And so NFTs, as you know, it's a big play with the metaverses that is upon us. And so a solution is definitely important. And I think Jake and you have brought at least an exit, and I'm very excited to connect with you guys. And at this stage, I don't have the right questions to ask. And they always say, if you ask the right questions, then you get the right answer. So it's my first exposure. So if anything, all I can do is maybe answer a few of your questions if you have that. But I do believe soon you guys are going to get tremendous amount of clients coming through Neptunize to you.
So real quick, Richard. And again, part of this webinar is to connect people and help make sure that, you know, again, there's a phenomenal exit strategy that is not truly an exit, in the sense that it is an ongoing, it is a tool that allows people to do more on an ongoing basis than if they were just to exit normally, right? Very intriguing what you're doing with these artists. I know an individual, and this may or may not be of interest to you, but he works with people like your artists and turns their art for NFTs into augmented reality. And so he takes what they do and he just does his little thing, and suddenly it's worth a lot more in the NFT space. Currently, there are people like Amazon Korea and others that are looking to contract with him for the augmented reality, which could then blow up. Just in my mind, with what I understand of it all, there might be a connection, and maybe we should make an introduction there.
I would love it. I would love to connect with your.
His name is Renee, and
okay.
After this call, I believe we have your information. We'll go ahead and connect you.
Yeah, and that's awesome. I'm looking for that right now. So you know, I'm selling 200 original of my $1 billion artists, and what we're talking about is $100 million that's going to be generated for my artist Ehsan. And this is his original that goes along with the NFT. Obviously, NFT has built-in royalties. We call that the royalty, or the royal members receive these 3% royalties in a decentralized way on all the flips of the NFT. So with this 100 million that's coming up on into the Ehsan's foundation, which is the artist, I call him the Picasso 2.0. And of course, he's going to use that money to build his VoIP centers, which is 17-story tall. His art is amazing. And basically, since Adam and Eve, I've never seen a better artist with a better collection that can be Neptunized than him. So we have $100 million coming in, most likely in our hand in about 2 to 3 weeks. Now, part of that is going to be burned in building these VoIP centers, like a large gallery that is a monolith the size of 17-story tall in 275 countries in the world. That's our plan, that we're building this. That's actually his mission in life, to do it. He's got 4,000 NFTs. But the question is, now we got $100 million in hand. Obviously, that's all capital gain. We're looking at quite a bit of money coming in, and we only got 1 year to burn it and put expenses behind it. But there are things that are happening here that is just incredible, especially in the metaverse and the NFT space. And definitely we need to connect with you. Also, in terms of formation, I know some of my artists, they want to be able to form outside of the United States in some sort of a tax haven. And I don't know, Jake, if you have the expertise or the knowledge to advise them. If you do, on a separate call, we can bring them on board, especially with Ehsan. He definitely needs some sort of a shield because the size of the art collection is tremendous. It's over 60.
Hey, Richard, would you just comment for a second? Are you inside the United States? Are your investors inside the United States? Explain that a little bit to me, if you would.
At this stage, yes, I'm a U.S. citizen. I'm here. I'm inside the United States. I live in California, in Newport Beach. My artist also is here in Southern California. But I know a lot of the so-and-so billionaires of cryptos that call them accidental billionaires, or the lucky ones, have actually denounced their citizenship just so they can shield themselves. But with your solution, from what I understand, is that you don't have to play those type of a game. You can actually shield yourself and extend that perhaps for the rest of your life. So that's the solution. I kind of doing the scratch surface. So yes, there are some solutions there. People are denouncing their citizenships. They choose to live in Costa Rica or some sort of a tax haven like St. Kitts Nevis. But the point is that why should they do that if your solution is going to solve their pain? And it's understandable because there's substantial gain in crypto, and now with NFTs, it's substantial gain of money, capital gain. So, and as I said, this is my first exposure. I'm just trying to learn more about your solution so we can recommend it, or at least connect you guys together.
So again, Richard, that probably would be another meeting outside of this, and Brett, love to have you there too. We do have a team of experts that deal with people who would otherwise consider denouncing their citizenship for some of the same purposes, whether it's because of crypto or something else altogether. So we have some of those very customized and tailored strategies, as well as the pros and cons of the various countries and all of that stuff. So I think there's probably 2 or 3 outside conversations to be had.
Okay.
And again, what Brett and I are bringing to the table with the Deferred Sales Trust during these meetings can be rather phenomenal and a life changer. Just as you mentioned, some people are considering renouncing or denouncing their citizenship because of a tax solution that is available for doing that. And would they do that had they known, or if they could find out about the Deferred Sales Trust and some of these other strategies that we have? Again, the Deferred Sales Trust is just one financial tool out of many, and usually should, for people like who you're speaking about, Richard, be combined with other strategies. And sometimes that's where you domicile for people who are not US citizens, or for people who are considering something different. But as well as, I actually have people doing the reverse. Because of the Deferred Sales Trust, we're having conversations about people trying to get US citizenship, because now it's not such a burden from a tax standpoint. And so because of the openness of the dialogue that Brett, as the initial founder of the Capital Gains Tax webinar series, right? We have found solutions that originally we weren't even necessarily aware of, but everything in this open environment has come together to help provide a better outcome for individuals with a capital gains type situation.
And then Richard also touched on that if he's planning on building a data center with all of that stuff, the question is, would you like to do that tax deferred, or would you like to do that after tax? And so what we're saying is the 100 million can exit into the Deferred Sales Trust, and the next day those funds are available via an LLC partnership, just like a client Shay did in Tennessee, and you use the funds to build, right? And so the answer is pretty simple. Would you like an interest-free loan from the government to go ahead and build your project with, I mean, I'd imagine on a $100 million sale, let's just say he would have paid 40%. So he can have 60 million and then you can go build the stuff, or you could have 100 million at up to 80 million the next day. Could go, the other 20 million's got to stay in liquid investment grade securities. We got to keep some liquidity. We got to follow some of the guardrails, but it's really a no-brainer when you're at that size and that kind of appreciation. The second thing is we move all of those funds outside the client's taxable estate, right? So the growth of that 100 million over the next, and I don't know, however old he is, goes to 200, 300, 400 million, goes to $1 billion. Guess what? It's all outside the taxable estate growing, which saves that 40%. And so the biggest challenge is when deals are like down to the wire here. It sounds like it's closing and it could be overwhelming, right? But we do have the bank in Irvine, right? Jake and I do get on planes every day, or every day for deals of this size, right? Put it that way. Pierce actually is in Newport Beach, and I was just down there, Richard, as we were talking earlier this week. I wish I would have talked to you a week earlier because we could have got together. But yeah, I mean, we're here to move as quickly as possible to make deals. Number two, we don't charge anything if your client decides not to do the deal, right? So for whatever reason, they're like, hey, we don't want to do the deal. We can't, no problem. We'll see you on the next one, right? Or it's too late. You know, it's already going to be done. It's okay. We'll see you on the next one. But we have a no cost, no obligation due diligence. And that's the way that Jake and I and Pierce work, if that makes sense.
Excellent. I have a question though. To me, when you do your legal works and you put together these trusts, does the size of the trust matter? So if somebody wants to shield $1 million versus 10 million versus 100 million, is it the same type of a legal efforts to put the documents together, the instruments together, or does it changes because somebody has now got to shield 100 million gain versus $1 million gain?
Great question. First of all, the cost is the same. So whether it's the DST 1.0 or DST 2.0, the cost is the same, which is very nice. Although every single deal is complex and particular and customized for deals that are above basically 10 million in any given year for unless they're a single individual and it's 5 million. We're going to be doing what's called a DST 2.0, known as a Deferred Sales Trust Plus, which there's no limit to. A deal that was done in San Diego was a $125 million deal, okay, for the Deferred Sales Trust Plus. And the reason we use that is there's no interest charge. Traditional installment sales in IRC 453, anything above 5 million per person per year in a given year, the IRS is going to charge interest to. So that's why we're not using IRC 453 for DST 2.0. It's not that part of the tax code. It's proprietary. It's protected. You sign NDAs, all that stuff, but it's been tested by the IRS. All that stuff. It's passed with flying colors. No change audits. So yeah, the answer is yes. It's going to be different, and the answer is yes. We do have a solution for bigger deals, and in fact, it's even more powerful because of the estate tax savings that we're going to give to your client.
So the wonderful thing here is we are not creating something new for what some people are experiencing as a new thing. When I say that is, so crypto it's been around a dozen or so, or maybe a little bit more in years, right? However, the capital gains tax, the rise of people experiencing a capital gains situation with crypto is somewhat new. And the nice thing is we're solving that. We're providing a solution that is ages old, decades old, to that situation. And so we don't have to recreate anything. We are utilizing the same tax code. And a lot of the new legislation or changes to the tax code have zero ramifications on this. The skeleton of what Todd Campbell, the brain surgeon, created this way back when, the skeleton of what he created has stayed the same. There has not been any significant changes to the recipe of what he does. And that is a very important thing. And I tell you that because I have reviewed strategies from a national association of CPAs. They get clients that go to these dinner seminars, whatever, and they pitch a new thing, right? And I was charged with vetting hundreds of these proposed strategies that the client would bring to the CPA would then bring to me as I was contracted with this association to verify, is this solid? Is it based on law and principle? Does it have a precedence? How old? How long have people been doing it? Has the IRS tested it? And 19 out of 20 of them were always like, no, we cannot as a group condone this strategy because either it's too new, there's no precedence, or it's fictitious, or it's a scam. But then every now and then there'd be something that would be wonderful and magical, and we'd add it to our list of 423 strategies that we would recommend to a client. Now, the Deferred Sales Trust is one of only 2 out of hundreds and hundreds of strategies that I've reviewed. It is one of only 2 strategies that has a 100% track record with the IRS. Meaning we don't try to say, well, for this client, it was disallowed, but for this client, it was allowed. So how do we gear our clients towards the way that it worked? We don't have to do that because it has always worked in its entire history. And there are only 2 strategies out of hundreds of strategies that I am aware of that we can say that. And the Deferred Sales Trust is obviously my favorite because it makes the biggest difference in somebody's financial life moving forward.
And it's also lifetime audit defense too, right? Because you want to know that the people who are providing this, which are business partners, tax attorneys, what Jake said, Todd, he's the one who's defended the actual clients versus the IRS. He's the brain surgeon. He's the tax attorney, CPA, and he's the one who provides lifetime audit defense, state or federal, no additional charge, right? So that can help you to feel, it's like an insurance policy, right? It's really nice to know that someone's going to stand behind that. It's going to cover all the costs and has a perfect track record. You don't want to show up to a surgeon who's never done an ACL surgery or a brain surgery and who's trying something new or has lost patients on the operating table or the patients have gone to jail. With the Deferred Sales Trust, it's literally batting 1,000. It's perfect. A dozen no-change IRS audits, 3 formal audits, and these were promoter review audits. Okay. Also, never been on a dirty dozen IRS watch lists. Like, it's perfect. It's great. And that's why we're here, right? Otherwise, we wouldn't be here because I wouldn't be pitching something that didn't have that track record or didn't have that the people behind it. And that's where in 2009, sitting with Todd, he's the smartest person I've ever met, going through the deal after deal after deal, fast forward the 6,000-7,000 hours of time with them, I said, I'm going to burn the ships. I'm going to go all in. But it's also why they don't just share it with everybody. Okay. I mean, they keep proprietary and protected. There's not 5,000 QI companies out there talking about this. One, because they don't want anyone to abuse it. We don't want anyone to abuse it. Number 2, we don't want competition. We want to make sure it's protected for our clients, for those, and make sure we do it correctly. Because in the past, things that have gone south or IRS shuts things down is because people they're abusing what's been made available, right? And we don't want to do that, and that's why we maintain strict guidance with everything that we're talking about here. Does that make sense, Richard? Any questions there?
Yeah, it makes perfect sense. Obviously, the expertise that you guys have in your team is very encouraging because when I was searching for intelligence, it was hard to come by, especially in my space, which is cryptocurrency, which for the most part is not regulated. And then on top of it, when I heard, when I saw you and found you on LinkedIn, I immediately gravitated to connecting with you and your team. So I now have, I believe, at least a phone call away from getting some answers. That's a key thing that I'm thinking right now. And of course, a lot of these things are evolving. Things are going fast. I know the feds are going to come out with all kinds of regulations that Biden is ordered to pass while he's here. The point is that it affects the crypto world tremendously, especially in the NFT world, with Facebook hitting and rebranding under Meta. That means they gave this new beginning to a lot of the entrepreneurs and cyberpreneurs, and a lot of the artists are going to get affected. And as I said, there's going to be fortunes built in NFT and metaverses, and expertise like yours is needed. And I hope that I can be in a position to bring some of that as they get onboarded to my platform towards you so you can advise them accordingly.
Absolutely, Richard. Thank you so much for sharing that. And that's why we're here. And that's the beauty of connecting the cryptocurrency world. We need your expertise, your relationships with your clients and partners and people that you serve. And we want to bring our expertise and the clients and partners that we serve and bring these worlds together. And beautiful thing is this tax deferral, amazing transformational plan that we can build together and help more people so that our friends and family and clients can have more wealth to give to the causes they believe in, but not having to force the charity, invest in the deals they want to invest in, diversify, build data centers with, all the stuff you're talking about. Like I'm really intrigued by all of that. We're learning about the crypto world, and I got my kids involved, and we're mining some Ethereum, right? Just small scale stuff in our house. We build the equipment. It's like a little hobby on the side here. But for anyone who's listening to this, you can go to capitalgainstaxsolutions.com. We would love the opportunity to sit down with you and walk through this scenario. Our minimum is $1 million net proceeds, $1 million gain, in case you're wondering. So we do have some minimums. Number 2, you can register for the free mastermind that if you're watching the replay of this, we'd like to invite you in. Go to capitalgainstaxsolutions.com, register for the mastermind, download the free ebook. And by the way, we're also coming out with our new book here, Building a Tax Deferred Exit Strategy, the proven playbook for unlocking your ideal wealth plan when selling assets of any kind for yourself or your clients. And we do have the Kevin Harrington from Shark Tank. He's actually chapter 2. And then we have the Jake Muller, who you just heard from a few minutes ago. He's the next chapter. And then I got a few stuff in there too as well with some other people. So we got to wrap it up here. I want to let everyone know to invite everyone or encourage you to invite someone next week. Invite your CPA, invite your skeptical friend, anybody, right? Everyone's open forum here. We want to help demystify the Deferred Sales Trust so you can create and preserve our wealth and help others do the same. If you want to reach out to Jake, where can they find you?
Jake at strategictaxsolutions.com. It's a new email. So let's go ahead and start utilizing it for everything that I'm doing here with Brett Swarts. We also have an 800 phone number, 1-800-773-1848. And of course, more information to come.
Excellent. And then Pierce, if people want to find you and buy a house in Newport Beach or do a deal, maybe, while we're down there, we'll get with Richard, maybe we'll get lunch next time I'm there. But where are you at, Pierce? Where can they find you?
Yeah, you can find me at Pierce at kingdomluxuryrealty.com or go to our website at kingdomluxuryrealty.com. Yeah, absolutely. Love to connect up with you guys. And
good. John Mudgett, where can they find you if they want to connect with a rock star multifamily commercial broker in Tennessee?
Well, I'd say LinkedIn is probably my best place to connect. John Mudgett, LinkedIn. I'm with Foundry Commercial in Nashville, so john.mudgett at foundrycommercial.com. I sent out a few invites.
Andrew, how about you?
Instagram at DrewKniff, DREWKNIF.
Fantastic. Richard, how about you if they want to get going on their all things arts and NFTs?
Best places to go to Neptunize.io, go all the way down. At the footer, there's a phone number and an email address. You can reach us through that contact. Of course, if you're a collector, if you are an artist, or if you want to learn about what Neptunize does, you can click on different parts of it and fill in the forms online, and someone will get back with you. But absolutely be more than happy to connect and answer anybody's questions.
Phenomenal. We're out of time, everybody. Hey, have a great rest of your week. Hope to see you next week.